Hey gang! So, I had this plan, right? I wanted to make a huge playlist with turnkey, ready-to-use trading strategies. You know, the kind of playlist where you could pick a strategy, learn what it's all about, and start trading ASAP. And I would only include the tried and tested ones. But the thing is, when I started making the playlist, I quickly realized that if I wanted to explain something and do it the right way, I needed to lay the groundwork for it, have a video or a few about the foundational stuff that I could later refer back to in my future videos. I'm talking about support and resistance, trend lines, volatility, money management, and other things without which you could never trade confidently. There is a video about money management on my channel already, so don't forget to watch it if you haven't. This one is going to be about trend lines and levels of resistance and support. Let's take a look at this chart. Note how the market reacts to this price range. When it falls to the level at which the majority of the market considers it cheap or appropriate, it suddenly stops going down. What you're looking at is the level of support. And it does exactly what it sounds like. It supports the price, so it won't go further down. Here at this level, traders see a good opportunity to buy, expecting the price to go up. And a very important thing here is that even though it's called a level of support, I think of it as more of a range. So it starts working from here and keeps affecting the price here. If you take a look at this one, you'll see a level of resistance, which is the complete opposite of the support. And it also does exactly what it sounds like. It creates resistance to the price going up. By the way, the level you're seeing right now is a pretty strong one. As you might have guessed, we can assess how strong a level is by how hard it bounces off of it. So the stronger the level, the lower the chances of the price breaking it. Levels can be either local or global. Additionally, they can be predictable or unpredictable. A local level is the one you might find on a shorter time frame while trading. Global levels are stronger and more reliable than local ones. You will typically find them when switching to a longer time frame. The go-to rule here is to find the global levels before even starting to look at shorter time frame. For instance, if you find a local support level and bet on it breaking, but miss the fact that there's a global support just below it, even if the local support is broken, the price will likely bounce off the global level hard. In other words, it has nowhere to fall. What it means in practice is that you must analyze the longer time frame charts before even switching to a shorter time frame. Global and local levels are pretty straightforward. Piece of cake, right? What's up with predictable and unpredictable levels then? Predictable levels are the ones you can predict. In other words, we understand the reasons behind them. I'm talking about levels that are formed at round numbers and Fibonacci retracement lines. If you take a look at this chart, you can easily find a strong level of support at 150. And trust me, you would probably see it long before the price gets to this level. They are formed almost uniquely under the influence of human psychology. Let's say you want to buy some Apple stock. It is trading at $161.45. And if you had to enter a price at which you'd buy it, you'd set it at 160. At least the majority would do that, just because round numbers seem much more appealing to us. Another kind of predictable level is formed at Fibonacci retracement levels. Fibonacci is something that deserves an entire separate video on this channel, which is certainly coming, so don't forget to subscribe so you don't miss it. Let me give you just a brief on it. to keep this video self-contained. Fibonacci retracement lines are a technical indicator based on mathematical patterns. Partly, what makes them work is that traders believe that they work. In other words, it's part math and part psychology, so it does bear some similarities with levels formed at round numbers. Still, what matters is that they do work, and that's the only thing that matters for us traders. The way you use Fibonacci retracement is relatively straightforward. You locate the most recent swing in price or momentum, open the Fibonacci retracement, and stretch it along it. Very important, you got to do it with the direction of the movement. So if the price is going up, you stretch it from down to up and vice versa. After doing that, you'll see several levels at which support and resistance levels may form. If the levels don't show, make sure you've got the same settings for the indicator. Last but not least, there are levels that I call unpredictable. Those are the ones formed at levels we can't explain, making them, well, unpredictable. We mostly trade currency pairs, and there's an enormous number of factors that can influence the price all at the same time. This is why a lot of levels we find on those charts are hard to explain, making them unpredictable. This applies not only to currency pairs, but any asset whose price is influenced by factors we know nothing about, whether it's bonds, currency pairs, or even a small company's stocks. And we're slowly getting to a somewhat controversial point. Here, I want to voice an unpopular opinion, but I'm 100% positive about it. When learning trading on the internet, you will often find people saying that a broken level of resistance becomes a level of support, and vice versa. I do believe it's somewhat true, but not all the time. Let me explain. I think it only works with predictable levels. Let's say an asset is trading in the range between $70 and $100. For a long time, there was a strong level of resistance at $100, but it eventually broke, and now it's trading between $100 and $120. In this case, $100 becomes a strong psychological barrier. But with unpredictable levels, the situation might be drastically different. Again, we don't know why they formed there in the first place. There might have been a big sell order, and all we know is that it might have played a role of resistance in that case. But we don't know that, and we can't know that every time. After all, it might have been a different thing. So when that asset will be trading above the initial resistance level, nothing will make me believe that the essence of it will change and the market forces will do a complete 180. This doesn't make any sense to me. Still, if the price drops below that initial resistance and starts testing it, I would count it as a resistance level. I think I said enough about levels. Let's talk about lines now, trend lines, that is. A lot of traders who are just starting out see them as another kind of level, just inclined. Trend lines represent the overall movement of the price, and it only works when there's a trend. Contrary to that, support and resistance work when there's no trend. You build a trend line by connecting the points the price falls back to while following the trend. Those points are called extremums. If you connect them, you can guess where the price will fall to next time. And this is exactly what trend lines do. They help you predict how far the price will fall with the next momentum. As with levels, trend lines should be viewed as areas rather than lines. How do we use it when trading? When it comes to lines, it's going to be one of two things. Either the market breaks it or bounces off of it. That means that one of the first decisions after pinpointing the levels or the trend you will have to make when analyzing the chart is whether you'll be trading against the trend or level or with it. The key to making this decision lies in the trend or trends, both local and global. If we do have a trend, we always trade with the global trend. This is my go-to rule. Local trends are best visible with 1 to 3 minute time frames. And for global, I usually switch to 5 to 10 minute ones. Let's take a look at a few scenarios I see most often. Scenario 1. The local and global trends are both directed upwards. And there are two distinct situations here. The market meets the resistance. So something prevents the price from going further up. And here, the market is trying to break the level of support. What I expect to happen here is for the market to break the resistance and bounce off support. Scenario 2. The local and global trends are playing against each other. In this case, the global trend is directed upwards and the local downwards. I also see two distinct situations here. The market is stopped at and tries to break a local resistance. And here, it tries to break the level of support. I'd probably go long with the resistance, but if the price is trying to continue downward, in this case, I would refrain from trading. What if there is no global trend, just local ones that follow one another? In other words, what do we do when the market's flatlining? In these cases, the most correct option would be to use reversal patterns, and more videos about them are in the works. Long story short, flat markets are a risky affair. At least they are less predictable than markets following a global trend. Reversal patterns are simply a series of attempts by the market to switch the direction of the trend, which usually results in a certain outcome, completing the pattern. That's why it's with flat markets without distinct trends where the direction is likely to change that we start relying on reversal patterns. Let me show you an example of that real quick. All right, now I'm starting to talk about patterns, and that means I should probably wrap up. I really hope this video turned out to be useful for you, and I'll be releasing a long one about the most common patterns in a few weeks. So please consider subscribing if you like this one. A friendly reminder, I do share all my trading signals as part of the affiliate program, and everyone who follows my link to sign up can use them for free when trading. See you in the next one. And as always, stay safe and be in touch.